Hey everybody, wanted to make this video to help everybody out, especially myself. It was great to review. Read your all's emails, and I hope some of you guys read mine. So here goes. Uh, for you guys, some of you guys it's gonna be review, and for some of you guys, it's gonna be new or something you haven't heard in a while. Um, This is the accountant's equation. So assets equals liability plus equity, which you guys have seen before. So I'm going to move through this one. So assets equal liability plus owner's equity. And we'll return to this material in a little bit. So here's kind of the simplified version up top. Assets, and there's no equal sign, but there should be assets equals liability plus owner's equity, or in this case it just shows equity. Now here's the big deal. On the asset side, you have a debit which causes an increase, and still on the asset side, so because this is double entry, okay, this is double entry, but over here it's down at the bottom, when in actuality it should be off to the side. This is followed by this side, or the left side, I guess you should say. This portion right here, I can't literally highlight it here, but this portion would be the asset side, and this side would be the liability or equity side. Okay? So what you have to identify is what type of account you're dealing with. This that you see, the flow of inventory cost, is actually off of chapter 8, the video. So somebody bought some inventory. So we have to go over here, and I took this straight off the internet, and we're dealing with a merchandise inventory. So we either debit or credit. Now I want to say something a little bit about debit and crediting. You see how this one is indented left? Well, when you see the indented left, by convention, by I think it was 1494 when it was codified, the way accountants do this. But the double entry has only been around 30 years. But anywho's, if you see this inventory, then that is what you're going to debit. If you see the indentation to the right, you're going to credit. And you see this again in the sale. What you debit is indented left. What you credit is indented right. So inventory is indented, so it's pushed over to the right side, and hence you credit that. Now let's go to this example. So in the video that the professor put up, there was a purchase of inventory. So inventory falls under here, merchandise inventory, and that is a debit. Okay, so you're going to ask, why, if I purchased inventory, why the hell is that a debit? Right? I had the same question too. Okay, so in 1494, when the system was created, the story goes that accounts only wanted to deal with addition. They were not to be bothered with subtraction, division, and multiplication. So hence came the parentheses and all that other business. So I'm not going to go too much into a history lesson, but here goes. Okay, so why do I debit it? Okay, so on the asset side, which inventory, this purchase inventory is now a debit when it appears on the asset side, I bought inventory. So, increase in inventory, I debited by convention. Okay? So that's why you see the arrow up. So I enter that my account inventory is going to be debited X amount of dollars. Now, because this equation has to always balance, well, since I debited this side of the equation, remember there's an equal sign here. So I debited this side. Now inventory is not going to be a liability. It's an asset, but it also falls into one of these two categories that make it balance out. Okay, so on the equity side, we purchased the inventory. It's not a liability. It has to be owner's equity. So the owner over here purchased this inventory asset. So will the equity go up or will it go down? As you can see, if it's equity, you're going to credit it. Okay? So now look here, go back. If you bought inventory and you are gonna do the posting, then the inventory you debit it. Okay, debit it and go over here, you debit. Say it was $1,000. So you would write inventory, $1,000 got debited. So your inventory went up. Now, debit, now you come over here and you know that inventory is equity because it's a part of the owner's equity. Cannot be a liability in most cases. But in this case, it's going to be equity. So, you're looking for accounts payable because you bought, but now you have to pay. So you bought inventory, but you have to pay somebody. So credit. So you're going to have to put the account in accounts payable. You're going to have to credit. So as you can see, it falls under equity or owner's equity. So maybe this will help a little bit more. Let me see. I don't want to flip much through this. But anyways. Okay. So here you go. Recapping. You find out what kind of account you're dealing with. Let me get to it. Identify the accounts. Increase or decrease in each account. How much did it change? Boom, that's it. Now, here, journal entries. And here's the journal entry. Account debited is all the way to the left. The account to be credited is indented right. Okay, so this is where you get this convention of inventory, accounts payable, and now you know that it comes from 1494 and what you debit and what you credit. And the most important thing here is that you realize that on the asset side, an increase is associated with a debit. A decrease on the asset side is associated with a credit or a decrease. In the opposite vein, equity is completely the opposite of an asset. So if you have an increase in equity, you're gonna credit that, versus on the asset side, you're going to debit it. Now, if it was a liability, you would also credit it. So on the right side of the equation, you credit and increases, while on the left side, you debit increases. In the similar vein, on the asset side, in a decrease, you would credit. But on the liability and equity side, you would debit the decreases. And all you have to do is go down here and find out what kind of account falls under. Either is it asset, a liability, or is it owner's equity. That's pretty much it. So going down here, the cost of goods sold, it's over here in equity, right? So you're going to debit, means over here you're going to debit because you're selling inventory. So if you debit, if it goes down, right? If your cost of goods sold, if you debit it, it's going down, which means that on the left side, something has to go the opposite way, right? So the inventory is going to be credited, correct? You see how credit and debit are opposite? I mean, they're both decreasing, right? You sold inventory, correct? So the cost of goods sold, by definition, and the inventory went down. But to understand why debit and credit, and this is by convention, debit is it's always going to be debit and credit like that. Why? It's just convention. And it comes from Venice in 1494. So all really you have to know. And that's a perpetual, but I don't really find much differences in other ones. Maybe expanding a little bit more. So take a look at it. Assets equals liability plus owner's equity. And you have paid in capital, or otherwise known as capital stock. I've seen it go through other names. So owner's equity can be broken down as paid in capital and retained earnings. Now, retained earnings can be broken down into dividends and net income. Net income itself can be broken down into revenue minus expenses. This is the statement of cash flow. On the asset side, on the liability and owner's equity side, you have the income statement and the balance sheet. The owner's equity, if you take it a step further, so going back, owner's equity. So here, equity, bam, bam, go here. Owner's equity can actually be broken down into these four: paid in capital, or owner's stock. It can also be broken out. It is also part of retained earnings. It's also treasury stock, like company's purchase of its own shares of stock and way to distribute cash and stockholders. It can also be accumulated over comprehensive time. I think I got a misspeller there. Okay, here's the expanded accounting equation. Assets equal liability plus paid in capital plus revenue minus expenses minus dividends. I'll leave that up later. Closing entries, balances are closed into retained earnings. Dividends are closed into retained earnings. Now, why is this? Because you simply have to zero out for the upcoming year. That's why you have to do these closings. Retained earnings include revenues, expenses, and dividends, which you already saw. You don't close assets, liability, and permanent equity accounts. The ones that you're gonna close are the balances and dividends and into the retained earnings. So you close a dividend account, you close an expense account, you close a revenue account at the year's end or whatever the fiscal closing is. The rules of debits and credits. So debits increase and credit increase, which you saw this, a bigger example of that. And again here, the journal entries from here to here, you have You identify what a type of account you're dealing with.